If there's one thing that we all unanimously hate as one united nation, it is... No, not her. Could be her, but what I'm talking about is taxes. That's right. Taxes are something that we can't really avoid. We may not understand it, we may not like it, but we have to pay it. Taxes are a pain in the backside, but it's like that ex-lover who rises once or twice a year and you can't really avoid them. Tax is something that I myself did not have a lot of knowledge about. I still find taxes to be confusing and complex. But if you're someone who's investing your money in something, you at least need to understand the bare minimum about taxes. You may ask why? That's because tax impacts your investments. Firstly, let me tell you that if you're thinking that anyone can get away from paying taxes, then that's not true. The government of India collects taxes for a reason. They need taxes to run the country, build roads, infrastructure, etc. The bottom line is, if you don't pay your taxes, you will be caught. Today in this video, I'll be explaining to you the basics about taxes in regards to three different investment types. First is fixed deposits, second is stocks and mutual funds, and the third is real estate. Also, we're not going to be discussing about GST or VAT or any other type of taxes today. First, let's understand what are considered to be different type of income sources. According to the Income Tax Act of 1961, income sources can be divided into 5 parts. Income from salary, income from house property, income from a business or a profession, income from capital gains, and income from other sources. This is pretty self-explanatory. Income from salary is your salary. Income from house property is any rental income that you have. Income from business or profession is any profits that you make in your business. Income from capital gains is any form of profit or returns that you get from your investments. And finally, income from other sources are income that don't fall in this category. Pretty simple. Chalo aage badhte hain. Fixed deposits fall under the last income category, which is income from other sources. The interest that you earn from fixed deposit every year gets added onto your total income for that year. Then based on what tax slab it falls under the income tax bracket, you will be taxed accordingly. For example, if you invested 1 lakh rupees as a fixed deposit at a bank at 6% return per year. So the interest that you've earned by the end of the year would be 6,000 rupees. So the 6,000 rupees that you earned as interest is taxable. The 1 lakh rupees that you initially invested is yours, so you don't need to worry about that. This 6,000 rupees return gets added on to the other income that you've earned for that year, which could be from a salary or a business or freelancing. Whatever you do, this income from other source will be added on to your regular income. Let's assume, including your regular income, you fit into the 20% tax slab. Then on that 6,000 rupees that you've earned, you'll end up paying 1,200 rupees as tax. Another point to be noted is that if your income from interest from fixed deposits is more than 40,000 rupees a year, then the bank will deduct TDS and deposit the rest of the amount into your account. TDS stands for tax deducted at source. So let's take another example. Let's assume you invested 10 lakh rupees in a fixed deposit at 6% rate of interest. You will earn 60,000 rupees as interest for that year. And let's keep the tax bracket the same, which is 20% tax slab. Basic mathematics, you'll have to pay 12,000 rupees as tax. What the bank does in this instance, since they have your PAN card details, they'll deduct the 10% tax and deposit the rest of the money into your account. So instead of 60,000 rupees, you'll have 54,000 rupees in your account. You now have to pay only the remaining 10% of tax on your earnings. It eventually turns out to be the exact same thing. You're not paying anything more or anything less. It's just the way the government has set things up. And this is how tax is calculated for fixed deposits. Now let's talk about taxes for stocks and mutual fund investments. If you invested your money in direct stocks or mutual funds, debt funds or equity, the taxation system is the same across all these forms of investments. Firstly, understand what are capital gains. Capital gains are the profit or the return that you get on your investments. So for example, if you buy shares worth 1 lakh rupees, the market goes up, the value of your share goes up. Now currently your investment is worth 1.5 lakh rupees. The profit that you make is 50,000 and that is your capital gain. If you sell your shares or book your profits in less than a year from the time that you've invested your money, it falls under the short-term capital gain tax bracket. So let's understand short-term capital gain tax. It's very simple. So for example, if you invest in a stock or a mutual fund today, you sell it in 8 months time and you make a profit on that, you will have to pay short-term capital gains tax on that. Short-term capital gains tax is 15% and that's the standard rate. Now what's long-term capital gain tax? Pretty simple. If you make an investment and you do not sell or book your profits for a year and you sell it after that, you will be liable for long-term capital gain tax. So if you bought some shares today and you sell it after a year's time, you'll have to pay long-term capital gains tax. Long-term capital gains tax is 10%, but if your gains or profits is less than 1 lakh, then you don't need to pay anything. So in a way, what the government is doing is giving you an incentive to invest for the longer term by charging you less tax. With mutual funds, there are certain instruments which are tax-free because they're usually very long-term and are related to capital guarantee schemes or retirement plans. But majority of stocks and mutual funds, they all fall under the same bracket of long-term and short-term capital gain. Now coming to the third and the last type of investment that we'll discuss today, that's real estate. If you are in the business of real estate, or if you have bought some property today and you sell it in a few years, how do you look at your taxes? The concept of capital gain is the same here as well. If you buy a house for 1 crore and sell it for 1.5 crores, then 50 lakhs is your capital gain. The good thing here is the government gives you an opportunity to account for the cost of the house and adjust it according to inflation. What does that mean? Let me explain. If you buy a house today for say 100 rupees and you decide to sell it after 10 years, the cost of the house is obviously going to rise because of inflation. So how the capital gain is calculated is cost of the house today 100 rupees. Suppose you sell the house for 250 rupees after 10 years and inflation adjusted cost of the house at that time would be say around 150 rupees. So your capital gain after 10 years would be 250 minus 150, that is 100 rupees. So what that means is you'll end up paying lesser capital gains tax. The rate of long-term and short-term capital gains tax is the same here as well. Two important things to remember here is if you sell your property and you reinvest that capital gain that you've earned to buy another property, you don't need to pay any tax on the capital gains you've earned. And you can do this for up to 2 houses. So according to a previous example, your capital gain was 100 rupees. If you use this 100 rupees to invest in another property, you will not be paying any tax on that 100. Second thing to remember is if you use your capital gains earned from another asset, say for example stocks, to buy property, you will not be taxed on that. But you have to use the entire proceeds from that investment and not only the capital gain. So you see, the government has these sort of schemes to encourage people to buy more property. These were the 3 investment types that are commonly used by people to invest their money. And I hope that you understood the basic concepts of taxation related to these investments. There are a lot more nuances and details about taxes which I have not mentioned in this video. I myself am new to taxation. I'm trying to understand how it all works. If you guys come across something that you want to know about, make sure you let me know in the comment section and I'll make sure that I bring out a video for you guys. Well, that's all from my side for today. Thank you so much for watching. If you did like this video, make sure you share it with your friends. You can also follow me on Instagram. I'll see you guys next Saturday with another video. Until then, is the Bombay Boy signing off. If you're someone who's interested in business, finance, entrepreneurship, soft skills, make sure you subscribe to my channel. You'll not be disappointed.